Okay. Hi, good morning, everyone. This is Paul here. We'll start the webinar now. We'll start off with SGX results. Okay, SGX released the results on late Friday. The key highlights was that the earnings was above our expectations. What drove earnings was predominant above our forecast was predominantly at the securities business. But the main growth driver for SGX, as you can see, is derivatives. Derivatives grew about 20% year on year. What was driving the growth in the derivatives business? As you can see from this point, derivatives volume surged 34% year on year. Part of the improvement did not translate to revenue because there was this decline in their contract fees. In terms of the types of derivatives that was driving growth, the bulk of it came from the China A50 and the Nikkei futures. But one of the fast-growing products for SGX is actually their foreign exchange futures. When we move on to the securities business, as we all would know, it was driven by an improvement in turnover. The SDAV, which is the daily average volume, was up 17%. But if you take it from the whole block, it's about 15%, because this includes adjusted for the days. So in total, it was up 15. But again, some of this, the revenue did not match this because there was a decline in the equity clearing fee. Equity clearing fee fell because of whenever there's market makers, greater proportion of market makers, then their margins are lower. Okay, then I'll move on to some of the positives that we saw from the results. Firstly, it was actually in terms of revenue, this is the highest ever revenues. The 222 million that you see for the third quarter is the highest quarterly revenue since listing. Profits was of course a 10-year high. In terms of the positives, was of course derivatives was a big growth driver. The second is that the operating leverage is intact. If you look on quarter-on-quarter, revenues actually rose to about 17 million, but almost 70% of it was captured on the bottom line. As you can see on the cost line 102, 104, so actually the cost was relatively stable. As volumes improve, there are certain volume link costs such as like royalty fee and so forth, but that didn't really move as much as, so they managed to capture a lot of operating leverage from the improvement in revenues. The other positive that we got out from the results was that SGX did mention that they're expecting a higher number of listings in FY18, not calendar 18, but FY18. So we can assume that will be another 5 more listings, at least for fourth quarter FY18, basically from April to June. And also, not in the slides, but in our note was that so far year to date, the amount raised from all the new listings is actually up 6 times. Okay, the big negative is, I wouldn't say large, but the negative we got out from results is mainly that there is, as you recall, on the Nifty 50 product, sometime in February, the Indian exchanges said that they will no longer support the license or the data feed for foreign stock exchanges or bosses. So what has happened is that as a result, on paper, all SGX Nifty 50 products, which is the Indian index futures products, could actually be shelved. I think they're looking at some time in August, if I'm not mistaken. But anyway, it accounts for almost 12% of the total derivative revenue. So this is a meaningful product. But what has happened is that the last week, 1 week ago, the SGX actually mentioned that they are actually launching another product which, as you can see, the point here, should seamlessly replace this Nifty 50 product. But they weren't very clear how the mechanics of this product. They only said that, despite repeated questions, they only said that this was seamlessly transition from the older product, and also this is priced off the publicly available reference price. Again, really unclear what that really means. As you know, the exchanges will not be providing them the data feed on the pricing. So I'm not sure how they're going to secure this publicly available reference price. But anyway, in our recommendation, we raised our profits by 4%. Likewise, our target price has actually been raised to 9.20. We still maintain our buy. I think the return of volatility, their continuous stream of new products, i.e. equity IPOs or new derivative products, and also the operating leverage will actually support earnings growth. We think valuations are attractive, and they are generating like 35% ROEs and 4% yield. Move on to the next slide. This is just to give some sense of operationally what has happened. This slide is basically their securities business slide. As you can see, the issue for them is the number of listed securities on the stock exchange. As you can see, it's been declining since 2016 or even earlier. So we hope that we want to see at least some stability in this, and with more listings coming up in the next 3 months, this should help stabilize at least the number of equities. In terms of the SDAV, our forecast is actually around that red line. We usually just take an average because, as you know, it's virtually impossible to forecast volumes. But we take an average, and so far, at least trend-wise, it has gone meaningfully above our red line or our average that we are forecasting in our model. Okay, move on to the last slide. This is just a reflection of the derivatives business. What has happened is, as you know, there's a healthy uptrend in volumes, helped by a lot by their new not just the equity futures, but some of the foreign exchange futures, which is actually picking up a lot of momentum. And also, so you can see this healthy uptrend. The other final point is that open interest is also still good. Open interest year on year from their March to March is actually up. March 17, March 18 is actually up 17%. So this, at least in the very near term, this is not a long-term indicator, but at least in the very near term, the strong open interest should at least keep the derivatives volume up. Okay, that's it for me. We'll move on next to Keppel DC by Richard.
Thank you, Paul. Yeah, for Keppel DC REIT, we are maintaining neutral. Target price also unchanged since our last report. Target price is 147, and for our forecasted DPU is 7.86 cents. That will give you a 5.5% yield based on last close price on Friday of 143. For the top line, the revenue grew almost 18%. That is from the full quarter contribution from 2 acquisitions they did. That's Keppel DC Dublin 2 in September 2017 and Keppel DC Singapore 3 in January 2017. Property expenses was correspondingly 16% higher. So NPI also was in line with the growth in gross revenue. However, distributable income and DPU are lower year on year for the quarter. That is because of a one-off capital distribution done a year ago. So if you exclude that capital distribution from a year ago, actual DPU, recurring DPU has actually grown 3.4% year on year. Operationally, the portfolio WALE remains long at 9.6 years. This is a quarter-on-quarter increase from 9.1 years. This is the effect of the completion of the acquisition of Maincube's data center in Germany. It was completed on 30th of March, so it was included in the WALE. This data center is on a 15-year triple net master lease. As a result of the completion of the acquisition, the gearing has increased from 32% to 37.4%. This is because they had drawn down loans to pay for the 90% balance payment for the data center. Occupancy is marginally higher from 92.6 to 93.7%. This is mainly due to the addition of the main Cubes data center into the portfolio, as well as Keppel DC Dublin 1 and Keppel DC Dublin 2, which both had a slight increase in occupancy. The laggard data centers in the portfolio in terms of occupancy actually are Basis Bay, that's in Malaysia, and Dublin 1. So Dublin 1 is still at 57%, although it increased marginally quarter on quarter. What is going on at Dublin 1? It was expected to remain low because the data center is currently undergoing AEI for the next 18 months or so. So the AEI is to upgrade the power efficiency, and the manager expects occupancy to increase after the AEI is completed. In terms of refinancing risk, there's no refinancing risk in 2018 because the debt has effectively been refinanced already. As of first quarter 18, there are some short-term loans, but subsequent to that, they have already been refinanced, so it's no longer on the balance sheet. Outlook for the REIT is stable. There's income visibility and very limited renewal risk because there's only 1.8 and 1.9% of NLA for renewal this year and next year respectively. And the other thing that hasn't changed is manager is still working towards achieving the 2 billion AUM target this year. Current AUM is about 1.6 B. So to highlight about the gearing at 37%, and if you put that in context with the AUM target, it's very likely that there will be some equity fundraising sometime this year. That would probably be done in conjunction with the next acquisition to bring the AUM to 2 billion. We think that the valuation is reached at the moment at 1.44 times price to book, and that's why we are having a neutral. No doubt with the acquisition that will grow the portfolio, but at the same time there will be dilution in the DP in the number of units, and that is why there's this mitigating factor again going against the increase in portfolio, and that's why we have a neutral on the REIT. Now we move on to first REIT.
Thanks, Richard. Morning, everyone. This is Tara. I'll be talking about First REIT's 1Q18 results. So we are maintaining a neutral on this counter with a target price of $1.31. For 1Q18, we reported a close to 6% increase in gross revenue and NPI. This was primarily on the back of contribution from the two newly acquired properties in FY18. So they acquired hospital and mall, the Bhutan property, in October, and the Salem Hospital's Yogyakarta in December. So we also see we have quite good visibility of their FY19 revenue, as well as if you know, their Indonesia property rentals are actually pegged to Singapore CPI. So 2017 there was an uptick in CPI, so that would lock in future organic growth for them, and we have adjusted our revenue forecast for FY19 accordingly. In January, they also secured financing facilities, so their 1Q18 debt has been phased out. A concern for us would be their receivables. In our latest report in FY17, we actually mentioned that their receivables went up 78% from the year before, and in 1Q18 it went up further 10%. So this actually represents 53% of the FY17 revenue. On top of that, Lipo Karawaci, which is First REIT's sponsor and the master lessee of First REIT's Indonesia properties, had been issued a credit downgrade by Fitch in February on the back of a reduced cash flow excess. So that would also impact our. We remain cautious on that front. Outlook-wise, as mentioned earlier, the uptick in the Singapore CPI will lock in future organic growth for FY19, and their current gearing level remains healthy at 33.5%. So this affords them a debt headroom of approximately 100 million to pursue inorganic growth. They have 5 pipeline properties, 2 of which are ready for injection into their pipeline. Sometime last month, they also released an announcement on an update on the new tax regulations in Indonesia. So these new tax regulations are not expected to have any material impact for them. However, we still remain cautious on any similar tax regulations that might come up later in the year or sometime in future that might have a direct impact on First REIT. So if you look at figures 1 and 2, their valuations, they are currently trading at about 6.2%, so that's well below the 7% average yield, and still trading at the upper range of the post-GFC valuation boundaries. On that note, we maintain our neutral rating with a slightly lower target price. This is mainly due to different assumptions following the change of analysts. Potential catalysts for this counter would be the improvement of the sponsor's creditworthiness. So with that, I will pass it on to Teh Hong to talk about Capital Mall Trust.
Thanks, Tara. Teh Hong here. Okay, I'll go on to touch on the results for CMT, which came out last Friday. As you guys can see the numbers, I think in 1Q18, DPU was up 1.8%. So in terms of operations on the ground, I think we are still seeing that tenant sales are still pretty sluggish. It's coming in about flat year on year. But then how they managed to get a 1.8% increase in DPU is via higher occupancy for 4 of their malls, namely IMM, Clarke Quay, Atrium, and PS. And also you see that property operating expenses actually dropped due to lower marketing and utilities expenses. So this was again because of previously hedged utilities bill, even though we see that oil prices are climbing now, but these utilities are actually hedged on a previous lower pricing basis. So this savings on that front actually contributed to a 4.7 increase in MPI. So all in, you see that DPU grew to 2.78 cents, and I think the bigger story, one of the big story for them also last week is that we hear about the sale of Sembawang Shopping Centre or SSC to Lian Beng, and the sale price was at almost 2 times the valuation price, and the valuation was done just recently at the end of 2017. So valuation price is about 120 million and the sale price is doubled at about 248 million. So at the exit price, this will translate to an exit cap rate of about 2.5% thereabouts for CMT, which is a very decent exit yield, I believe, because if you look at the cap rates for normal retail mall suburban, they range in the high 4% to low 5%. So I think the rationale for the buyer at this juncture could be the fact that this is a 999-year leasehold shopping mall. In Singapore, you seldom can find a shopping mall or a commercial asset with a freehold title anymore. And if you look through CMT's portfolio, this is the only one with a freehold, so-called freehold leasehold. The rest of the malls are all on 60 years to 90 years leaseholds. So I think that could be one of the motivation from the buyer's point of view. And secondly, also, if you look at the NPI margins for SSC, Typical, if you look at this NPI margins, meaning this NPI over gross revenue, if you look at a typical mall, this tend to range between in the 70s, maybe low 70s. So your NPI over gross revenue, low 70s, and SSC was doing about high 50s. So I think there could be a possibility that the buyer thinks that there is a chance that they can improve this margin, and so from there improve the yield of the property. Another thing that happened for CMT in the first quarter was the refinancing of all the debt that is due to expire this year. So that debt is worth about 600 million Sing, and one of the biggest constituents of the debt expiring this year is a 400 million US dollar medium term note. That one is a 6-year note that was first taken out in 2012. So that has been refinanced to a variety of bank loans ranging from a tenure of between 1 year to 4 years. So given that the debt that is used to refinance the older MTN is of a shorter tenure, so it would not be surprising to see that your interest costs on the new debt is actually lower. So on that refinancing note to lower interest costs, shorter tenure debt, you can expect that the financing cost for CMT this year is likely to remain stable, given that almost more than 90% of their debt are also hedged on fixed rates. And another thing, this is as I mentioned earlier, overall operations on the ground, tenant sales is still, we have yet to see a meaningful recovery. Even though rental reversions this quarter there's a bit of moderation from the minus 1.7% we saw in FY17. For this quarter, rental reversions was about flat, and if you look at tenant sales on the whole is flat also, but there's the biggest sectors for the mall, the three biggest sectors, F&B, fashion, and healthcare and beauty, which takes up about 55% of total rental income. These three biggest sectors are still posting about flat, are still struggling to maintain or to post any meaningful pickup in retail in tenant sales year on year. But that being said, there are still certain bright spots in some of these sectors that the mall is seeing. Namely, I think electronics is doing pretty well. I think could be a lead on from the buoyant property sales. So electronics was doing about a double digit year on year growth last year, and in 1Q this year we saw another double digit, about 15% growth in that subsector. So overall, the outlook for CMT is that financing costs, as mentioned, can expect it to remain stable. We are forecasting a cash top up in FYs 18 to 20 to make up for the loss of rental income from the sale of SSC. So our DPU forecast for FY18-19 remains unchanged, because any fall off in the loss of income has been topped up using our forecasted cash from the divestment proceeds. And for us, we see that even though rental reversions have moderated a fair bit this quarter, we see that the tenant sales have not recovered enough for us to build in any meaningful pickup in reversions yet. So all in, we maintain a neutral. Our target price is raised 2 cents to 205, and primarily this is because of the divestment gains of about 100 over million, which translates to about 3 cents a share. And the last, based on this current price, the yield currently would be about 5.4%. Okay, with that, we have come to the end of our presentation today, and we welcome any questions that you have.
Hello, this is Richard speaking. There is a question on outlook for industrial REITs. If I think if we defer back to our latest report, that was actually quite out of date, but we still think what hasn't changed is supply is tapering this year, and we still think that rents should bottom by the end of this year. However, rental reversions are expected to still be in negative territory. I think we can give more updates after next week because of two reasons. First reason is only one industrial REIT has announced its results, so the rest of them will be announcing within the next 2 weeks. And moreover, JTC will be publishing their first quarter 2018 data next week as well. So I think we can give more clarity on the outlook for industrial REITs after all these data has been made known.
Hi, there's a question on First REIT's lease renewal. So let me go back to the slide. So the reason why the uptick in CPI in 2017 only fits into the rental renewals for 2019 is because most of their leases were actually commenced in December. So in a way, there's a 2-year lag. So for example, if they renew in December 2017, meaning this year, so January 2018 will be acting on the 2016 CPI still.
Hi, there's a question on CMT's Raffles City when the recent AEI will lead to meaningful pickup in tenant sales. I think the AEI for Raffles City, from the way I look at it, is mostly aesthetical. So there's no increase in there's not much increase in NLA other than an additional podium set up on the 4th floor for this new cafe. I think for a meaningful pickup in in rents for this shopping mall, you have to see that tenant sales has to grow first, because as we know that CMT is already facing one of the highest occupancy costs that they have seen since they have IPO'd, and then tenant sales is also not picking up correspondingly. And I think also important to note for Raffles City is that this under this trust that owns the Raffles City building, the RCS Trust, which CMT holds as a JV, they also issued an MTN in March, just last month, and I think we saw that the financing cost for that MTN that they issued has actually jumped to 3.2%. For, I can't remember, it's a 6 or 7 year MTN. They did a similar one last year and it was about 2.6%. So I think there could be a bit of interest costs increase pressure on that front for RCS Trust. So we will be having a meetup with the management this week, and if we do get small updates on that note, we will update you guys accordingly. And for the outlook for S-REITs as a whole, we are still neutral. And this is on the back of valuations being on the more expensive side of things. If you look across the average valuations from 2010 to now, and also on the expectations of some of the macro headwinds coming in, like interest rates hikes, Fed balance sheet tapering and all that. But I think as Richard also mentioned earlier on, we are going to have quite a few results reporting this week. So this week we will have CapitaLand Retail China, we will have CapitaLand Commercial, and so I think next week will be a better time for us to give more updates about all these results.
Hello, this is Richard speaking. There's a question on Cash Logistics Trust, whether the price is bottoming this quarter. I think a lot of it will depend on how the manager utilizes his headroom now and whether they can acquire accretively or not. So the gearing now for the REIT is relatively low. I think it's about 35, but the yield is also a bit on the high side, so they would need to be a bit judicious in how they acquire properties to grow the portfolio.
Hi, this is Paul here. Thank you for your questions. There's one question on bank results will start this week. What's your view? Do you expect it to be above market expectations? In terms of the bank results, it will start on the 30th with DBS, then on the 3rd with UOB, then 7 with OCBC. Anyway, we do think that there should be some upside on the results. The two potential upsides will be from the margins. As you know, SIBOR and also the HIBOR or SOR have all surged at least year on year. So that could be one upside. Loans growth in Hong Kong especially has been really strong. The only thing is that loans growth in Singapore has been a bit softer. And also, like we mentioned before, with the high volatility, it will impact a bit on the wealth management business. So it's the margins that will be the one that the market will be looking for in terms of upside. And for those who've got Hong Kong operations, so OCBC and DBS should have better earnings growth because of their Hong Kong operations. Thank you.
Okay, we'll wait for another couple of minutes. Now, as of now, we don't see any more questions. Okay, if there are no further questions, we will call an end to today's webinar. Thank you all for tuning in, and we see you guys next week. Thank you.